Sorry, Tunde, I'm trying to. So today, Tunde will be discussing accounting and taxation for startups. Well, before we continue, I'd like to confirm that are you on the YouTube? Are you on YouTube? Can you confirm what's happening? I'd like to confirm how many people are there. I'd like to confirm how many people are there. I want to know what's showing up on. I want to know what's showing up on our YouTube page. Yes. Okay, I'd like to know what's showing up. I need you to monitor that for me. Guys, if you're here, Tunde, is my screen, Tunde, which screen is showing?
About StartupSouth.
Okay. Okay, great. So if you're here as usual, it would be nice for you to just say hello on the chat. Let us know that you're here. Please, those of you trying to call me, this is not a good time to call me. Is it possible to call me after 3 p.m.? Please, this is not a good time to call me, okay? So I'd like to say that, please, as usual, just introduce yourself in the chat so that we know who is here and know who. Just tell us your name, tell us where you're joining from, tell us your startup if you're running one. It's very, very, very important, okay? Please just let's know that you're here. So just send us a message on WhatsApp. Tell us that you're here. So we have, let's do that and then copy the link and share. Let us know. Copy the link. Did you share the Zoom link with someone, Tunde?
Yes.
Huh?
Yes. Okay, you might need
who's
to.
The person, please? Huh?
Hello?
Who is the person, please?
I put it on my group.
No.
Okay. Let me remove that. You can remove them from the Zoom.
Yes, send this link. Send the YouTube link to them, please.
All right then.
Yes. Okay, guys, please forgive me. Everybody needs to join from YouTube, not on Zoom. Okay. The YouTube link is on the StartupSouth group today.
That's fine.
Just let them know that they have to join from there.
I've seen it.
So everyone, please say hello on the chat. Just say hello on the chat and let us know where you're joining from. Very important for us. Okay, so while we are on this, I'd like to just talk a little about StartupSouth. StartupSouth, we're inspiring a generation of founders building high-scale venture in Nigeria, especially in the south and the southeast of Nigeria. So we hold these sessions regularly to educate our community. So if you want to join our community, the link is bit.ly/join S2C. That's the link to join the community. And so I would also like to mention, you can see on the screen that we have a partnership with Nextpod. Which is an online university that it is a virtual university. And not only is it very quality education, it's very affordable education, and it's very flexible. And so what is happening is There is an application fee that you need to pay, about $20. This partnership waives that $20 for you instantly. You do not need to pay that application fee if you are a member of the StartupSouth community, or you register with the link showing on your screen, which is bit.ly/ss-scholarship. If you register with that link, you automatically get the code with which you can sign up and the link with which you can sign up on NextFord to get access to NextFord quality education, courtesy of StartupSouth. Now, additionally, StartupSouth has a scholarship program with NextFord. So those of you who are interested, you could get a scholarship. It's a partial scholarship. And the condition is that you register and pay for your first month. You pay for your first month, and if you complete your first month, you complete your first course, send us your score, and the top scores will get a partial scholarship. You get your next month paid for you. Depending on if you're doing PhD, if you're doing your master's program, you'll get 50%. If you're doing normal program, degree program, you get 100%. Without wasting any more time, I would like to bring on Tunde. Tunde, go ahead and share your screen and take over. I was talking about NextFord before that small hitch. So just go ahead and let's not waste further time. So I'd like to just invite Tunde now to take over the session. Tunde, can you share your screen?
All right. Good afternoon, Uche.
So at the end, if you have questions, please put them down on the chat. At the end of this session, I'm going to be reading out most of the questions, and I'm going to be reading out most of the questions, and we would have to, Tunde will help us answer those questions. Tunde, over to you. Thank you for joining us.
All right, Uche, good afternoon. Let me be sure you can see my screen.
Yes, we can see your screen, Tunde.
All right. It's just 20 minutes past 2. That's quite some time that we've spent so far doing the introduction. Basically, we're talking about accounting and taxation for startups. And I want to thank the network, the StartupSouth, as we try to build, connect, and grow businesses. And as we grow businesses, individuals, and as we grow individuals, we grow businesses. As we grow businesses, we grow the region. And as we grow the region, we grow the country. And in all of that—
Tunde, consider being a bit more audible.
Okay. And in all of that, we build a better global village for businesses and people to thrive. Am I audible enough?
Yes, you are.
All right. This afternoon, basically, I'm going to just talk about basic accounting. I won't try to be too technical so that there is better understanding for everyone here. And the issue we are discussing this afternoon is basically the core issues of business. Apart from the fact that you have to have a product or service and you have to have a market where you are selling your product or service, the other major big issue is the issue of finances and record keeping and all of that. And basically, there are some important facts that I want to share with us. Number one, anybody can have a business name or brand. Anybody can form a business. Number two, anybody can, any business can be started by anyone. Business is actually poorly defined or totally misunderstood, by a lot of people. And then, of course, in this age, anybody can be called a CEO. And then one other fact is, anytime there is a new idea, a new business starts. And why did I say so? Anytime there is a problem, then solution has to be profiled. And once solution is profiled, that results into a business. Now, that is the start point. But the other fact is that not everybody can run a successful business, and not everyone can successfully manage a business. One other thing that results into what we want to talk about today is basically that every business registered is an indication and expectation for revenue for government. What do I mean? If you go to CAC to register your business, or you go to any registering agencies of government to tell them that you want to register a business, or you eventually register that business, what that means is that government has an expectation from you and from that business. And of course, I also want to clear that not every business is a startup, no matter how small you start. And lastly, every decision made has a financial implication. And that brings me to the fact that even if you decide to run your business poorly, or you decide to run your business in a very wonderful way, it has financial implications. And every decision taken, every financial implication has a tax implication. So here is the truth. You as a business person, you as a business owner, you as a startup, you cannot run away from these two things we want to talk about. One aspect of the things we want to talk about is the accounting aspect of business, and the other is the tax aspect of business. Why is this important? And why am I able to talk about it? It's my about 22nd year in business. I haven't been trained in these particular core areas, so I have helped many businesses to structure their finances, to structure their records, and also attend to their tax matters as a result of them doing business either in the state or as a limited liability company that does business with the Federal Inland Revenue Service, which is the agency of government that administers taxes in Nigeria. So I have this knowledge of how businesses have been run, and of course, how those daily activities, either operational activity, financing activity, or investing activities, these are the core areas of activities of business, areas of operations of business. We have the operational area, we have the financing area, and we have the investment area. All of these three aspects of business result into one tax liability or the other. And of course, we have to be aware of who and who we are dealing with. The first, of course, is the Federal Inland Revenue Service, which is the agency, as I said, established by an act of parliament to impose, assess, collect, and manage taxes for the federal government. And some of those taxes include the company income tax, which is as a result of either a profit or a loss or a break even. The other one is petroleum profit tax, education tax, capital gains taxes, value added tax. And then, of course, we have state internal revenue services, which we call the SRS. These revenue services are basically established to manage taxes of individuals and companies operating within the state with employees, and of course, taxes that has to do with individuals, such as withholding taxes, personal income taxes, operational levies, and all of that. Now, what is the understanding of accounting? Most people think accounting basically has to do with okay, how much did I have? How much did I spend? And what is the difference? No, it's gone beyond that. Accounting moves from record and bookkeeping into proper financial management, which has to do with collation of data, classification of data, summarizing of data, presentation of data, and at the end of it all, interpretation of all of those transactions for proper decision making for every stakeholders of that business. Every business has got a stakeholder, whether they are type of stakeholders that have interest or no influence, or those that have influence with no interest, or those that have both of interest and influence. There are major stakeholders and who require accounting for different reasons. Investors, suppliers, debt vendors, debtors, employees, management of the business, even fund providers like StartupSouth is doing to bring people and owners of firms together, businesses and owners of firms together to ensure that where there is shortage of or supply of funds, there is a bridging of such gap. And of course, tax is one area that most Nigerians, I don't know how many people are joining us from outside of the country. I know that when we talk about tax, a lot of Nigerians don't like to hear or do or pay taxes. Now, what does tax mean? Tax is both a moral and legal item. A moral in the sense that, is it right to pay taxes or is it not right? And then legal because it has a statutory framework that backs it up. Now, tax has to do with anything that is backed by law imposed on individuals, that's citizens of the country, whether corporate or individuals. Once there is a legal backing and it has an identified and known amount, then it is called tax. And it is compulsory. That's what makes it very, very interesting. Now, when it is compulsory and it is taxed, it means that the only way you can avoid it is by legal means. But once you evade it, it becomes a legal issue. Now, tax is also what is collected for the redistribution of wealth all over the nation. You collect from those who have and give to those who do not have, not in cash, but sometimes in cash or in rebates or in allowances or in palliatives, in whatever form. You collect from those who have, you collect from the areas that have to give to the people who don't have or to the areas that don't have. And how is that done? By using it for infrastructure development, for economic growth, for fiscal policies, and all of that. Then when we are talking about accounting and tax for startup, we're saying that every business transaction that a startup gets involved with or deals with or carries out has a tax implication, whether it is income or revenue or turnover, whatever you call it, whether it is cost or expensive, whether it is an asset or liability, whether it's capital or equity or debt, whatever transaction that you carry out, whatever activity that you carry out that can be measured in financial terms. For example, if I leave Port Harcourt for Lagos as a business person, what is the financial implication? The financial implication will be the cost of transportation, the cost of upkeep, the cost of accommodation, the food that I eat. All of those things may not mean anything until I sit down to look at the financial implication of all of my activity, moving from one place to another, talking to one person, using my phone, browsing the internet, sending documents, uh, transporting or commuting from one point to another. All of these are activities, but all of these activities have financial implications. And all of these financial implications have tax implications, which can be either allowances or liabilities. Of course, as a startup, because I am involved in the financial support services in the startup network, I have seen a lot of persons who have great and wonderful ideas. And I must say that in the past few years, about 6 to 10 years, I have seen businesses grow from ideation to proper, well set up, well run, well oiled businesses. Recently, I remember when we did the first StartupSouth. You remember Uche, there's a guy who was doing something about fashion with artificial intelligence. And as at then, I think he was the first winner of that pitching that we did. I think it was in 2013 or 2014 or thereabout. And he called me after then and spoke to me about the ideas that he had, how he was going to move it and scale it. And honestly speaking, I didn't really see much of a big deal in what he was talking about, even though that very day, about 5 persons pitched or 10 persons pitched, and he was one of the winners for that very day. And today, sincerely speaking, this guy is paying us monthly for financial services. And this was a business that I thought, okay, this idea is great, but it looks so vague to me until we sat down to understand all of the processes. And it's doing very well. What I'm saying is that for every startup, from ideation stage to scaling to even exit or to business combination to sell off to buy in to buy out to whatever you can call it, there is a financial implication, and for every financial implication there is a tax implication. Now let's look at what we call pre-operational cost. Most of the times young people come together to set up a new business, and they sit down so many times, racking their brains, taking coffee, traveling, doing research, carrying out tests and all of that. And there are costs involved. If you as a startup, you're not taking note of all of these small monies, small costs, small funding that is coming out of your pocket as an individual because you didn't see them as huge, by the time you look at how much has come out of your purse without any external funding, you will have realized that you have spent so much money that you did not account for. And it has implication. What is the tax implication of pre-operational expenditures? One, you are giving all of those monies back by federal government if you are a registered business, which takes us to the fact that every business has to be registered. What that means is that you have to legalize your business, no matter how good your idea is. If that business isn't legalized, if that business isn't registered, I saw people talking about the recent ban on Twitter. Government said they should have to come and register and all of that, even though people don't understand the purpose of registration and all of that. I'm saying that if you're here watching us, listening to us, it's important that you get your business registered with the relevant authority. Particularly if you're operating in Nigeria, you have to register with the Corporate Affairs Commission, the only body legalized and allowed to register 3 different kinds of businesses in Nigeria. The first one is a limited liability company, a company with shares. The other is a company without shares, which is a business name or a proprietorship business. And the other one is a business with not-for-profit nature or trustees. So you have to register your business. Now, I was talking about the whole of amount of pre-operational costs. And example I gave was the amount it costs you to register your business, to get it registered, the amount it costs you to ideate your business, to bring it into fusion, from ideation to logical existence, all of that amount, the advertorial, the strategy session, the advisory services, the telephone, the web setup, the design and all of that, your branding, your onboarding, and all of those costs. If you are able to prove to government that they are reasonable, they are holy, they are necessary, and they are exclusive, government gives you those of all of those costs back as a tax allowance. People say, do Nigerian government give allowances? Yes, Nigerian government gives allowances, tax allowances, not in cash though, but in terms of initial allowance, investment allowance, in terms of annual allowance, in terms of payback and reduction in your tax liability that is a subsequent result of all of your activities. So, but how will you miss that if you do not have record of what you have spent? Recently, we were trying to do financial due diligence for one of the startups in the community. And the questions we asked were, do you have record of all of what it takes you to set up this business? Do you have all of what it takes you to have people come together, the promoters of the business, the advisory board, all of the time you've spent and all of the input you had, the assets you have acquired, your laptops, your tables, your office that you rent, and all of those things before you start earning money or before you start making money as a business? What are those costs? What is the total cost? If you're able to prove beyond reasonable doubt when government comes for you or when you present your records to government for tax purposes, government give all of those things back to you. It is called capital expenditure because they were cost of setting up your business. For example, cost of development, cost of purchase, cost of production, cost of conversion, cost of acquisition, cost of app development, your transfer to foreign app developers, software engineers, and all of those things. All of those costs, if you're able to reasonably, wholly, necessarily, and exclusively prove that all of those things were actually spent on the business, then government gives you everything back as an allowance. It's amazing. Now, government also looked at the issue of pioneer startups. Now, some of us have developed something, have developed programs, have developed businesses that are pioneer in the area that we are setting them up. For example, if you use, say you use ethanol to build or to develop fuel for vehicle, or you use charcoal to develop something or to power or to generate electricity or power, and it hasn't been done before, government gives you pioneer status up to 5 years, between 5 years and 7 years or thereabout. And what that means is that between that time that you gain that pioneer status, even though you have to come forward to government to present your case that you are the first person to do this, government gives you tax allowance and holidays for the whole of that 7 years. If you are able to do technology transfer and you're able to prove that you're bringing in a technology that is novel, that is wonderful, government also gives you an allowance for that. So we must take care and take note of all of the things that we are spending money on or that we are incurring as expenditure. Okay, all right. So the next one is our product or service. Now, for every aspect of business, whether customers, employees, services, or production, whatever you have, every aspect of your business that constitutes your basic operations, whether ordinary operation or extraordinary operation, all of them have accounting and financial implications. And like I said, every accounting and financial implication has a tax liability or a tax allowance. So if you have a product that you are selling, if you have a service that you're rendering, everything that surrounds all of this, whether customers and clients, for example, when people come in to patronize you, you have developed an app, you have developed a product, you have render the service and people patronize you. Once people come to the knowledge of your business and they engage with you and they patronize you, then there is a tax implication. What does that mean? For example, let's take KR Foods, who sells palm oil, and it has developed a kind of palm oil that people love, and then people come to do business with them, and you are selling that product. For every sale that you make, it is either government expects a certain amount of money from you as tax or as an advance tax taken from you. So if you're rendering a service, I know that a lot of us are in the digital space, and the action is that you will have to look at what is the record of all of the money that I have earned. Where did I earn the money from? How did I earn that money? And what is the volume of the money that I earn? At the end of it all, you will see that you will need to pay what we call value-added tax, which is basically a consumption tax on turnover or on services that you have rendered that generated money. So most people here will say, what do I do that I have to pay all of these things? For every sale, for every income generated, for every activity of your business that has earned you money, government expects that you submit or you remit or you file what we call value-added tax. And if you are the one patronizing someone, if you are the one buying off someone, government expects you to be somebody that will help it to generate that tax from the person that you are patronizing. So this is very, very important. And if we are not able to keep record, then we will run into problem with government. Now, for every sale, we know that the new finance bill says that if you are not into agriculture, core agriculture, if you're not into agricultural business, you are not making turnover of up to 25 million naira a year. Those two people, and if you're dealing with education or dealing in education, if you are dealing in basic food items, if you're dealing in commercial transportation, if you're dealing in medical services, you are exempted from charging, paying, remitting, and filing VAT. But every other business. Now let's take startup, for example, in our community. You have an app that you have developed to help farmers generate more revenue. You are not an agriculture company. You are a tech company that is operating in the agriculture sector. So it means that every of your revenue is subjected to VAT. You are different from the farmers. You're different from those who engage in agricultural activity, whether input, whether warehousing, whether training, whether fertilizing, whether seedling, whether harvesting and all that. But the moment your services is not basic, for example, if you have a restaurant, you say you're selling food, but the moment you're packaging the food, people come in to buy and they pay you for that services, that service has to be subjected to VAT. And if anybody is dealing with you as a supplier, as a vendor, as a service provider, for example, if I am rendering service for KR Foods that produces palm oil, even though I'm relating with KR Food that is into agriculture, my services will be subjected to VAT and my income will be subjected to WHT, which is called withholding taxes. So my financial activity in all of that circle will be subjected to VAT and WHT, which are taxes. Now, government expect us, if you're dealing with anybody who is giving you supply, for example, if you have okay, I have somebody who is into an app that was developed to help taxis, to help cab drivers get customers. You will say you are into transportation, but no, you are using technology to aid people in transportation. So your services is subjected to that tax that I have mentioned. If you are not able to keep your records, government look at it and say, okay, you've earned so amount of money. This amount of money is subject to this amount of tax. If you're not able to prove that all of your income comes from this side or that side, government takes it that all of your income will be subjected to that. Let me move on. If you employ staff as a startup, I see a lot of people who have maybe developers, app inventors, code and program writers and all of that in their business, and you pay them regularly for services rendered. Government expect that all of those financial transactions that move from your company to those people should be subjected to a withheld tax or a personal income tax of those people that are earning money from your business. Most of us have people who earn money from us as salaries or as professional fees, and we are not deducting taxes from them. What does that mean? It means that we as startups, we have infringed on tax laws, and ignorance is not an excuse. If you refuse to take taxes from every financial application that you ought to take taxes, your company, your startup will be the one that will pay that tax. I have a file that I'm currently dealing with. A company paid as high as 900 million naira to service providers, different service providers. And out of that, we have people who supplied to the tune of 80% of that 900 million that the company did not take withholding tax from their services rendered. And it is going into the tune of almost 40 million naira. Government is saying, for your inability to deduct that amount of money from those people, and you let them earn money off you without you paying or without you deducting those taxes, then you have to pay for them. Now, imagine you are doing so well as a business and you have employed people. You employ an admin manager or front desk officer. You've employed a business manager. You employ a CTO or CFO, and you're paying them salaries, and you're not taking personal income tax from them at the rate of 7% graduated to 24% based on their salaries. If anybody is earning 300,000 from your service, from your startup, you should deduct 7% of that 300,000. If it's earning more than 300,000, less than 500,000, you should deduct 7% of their earnings and remit it to the state in which you are operating. If you're operating in Owerri, you have to deduct and remit to Imo State Internal Revenue Service. If you're operating in Asaba, you deduct and remit to Delta State Internal Revenue Service. That is what the law says. And that is a tax implication of you employing someone who you need to help you do your business. What about pension? If you're prospecting, if you're doing business and you're hoping that you're going to do something big and you're going to do something huge, maybe with IOCs or with big businesses, they will ask you, you have to provide for pension of your staff, people who are working with you. Even those who are on contract with you, you have to find what we call the health insurance or group life assurance to show that these people that are working with you are safe, particularly in this COVID-19 era. I don't want to say post-COVID because we're still having a lot of issues here and there. So your knowledge of the tax implications of every financial services or financial transaction that you're rendering is very, very key. And I need also to take note of all of these things. One, value added tax, which is charged on services. Apart from those rendering services in education, if you're into core basic education, if you're into agriculture, if you're into health services, if you're into commercial transportation, all of those people are exempted. And now, if your turnover is less than 25 million a year, that is, if you're earning maybe 2.1 million every month and less than that, or 2 million every month and less than that as an income, you are exempted from charging VAT or doing VAT at 7.5%. And I've also mentioned you having customers, they come to buy from you, you have to charge them VAT at 7.5%. If your services is not or are not exempted from VAT. Two, you have to understand that in your business, you acquire assets, either by intention or by virtue of your business. Maybe, for example, you need an asset, you need a laptop, you need a desk. All of these things are financial transactions, and the records must be kept. As a startup, I see, because most of us operate in the digital space. You buy laptops, you reinstall, you ensure that that laptop is equipped with softwares, you download softwares, you pay subscriptions. All of those things are cost of upgrading when, okay, I can see question when people earn more than 300,000. I might have to just say that now for staff, 300,000 per annum, that's what I mean. So let me just explain that in a go. If somebody is earning 25,000 naira every month in your business, that amounts to 300,000. Now, by the time you remove the allowances, government actually gives allowances. There's what we call consolidated relief allowance of 200,000 flats. And there's what we call personal allowance of 20% of your total money, 20% of 300,000, plus the 200,000 plus additional 5,000. If you're doing pension, government also gives you pension as non-taxable allowance. If after deducting all of that from your total salary for the year, and you have 300,000 left, that 300,000 will be taxed at 7%. That's the law. If after deducting all of that 300,000, you have 600,000 left, that 600,000 will be taxed at 11%. It's a graduated rate. If after deducting all of the consolidated relief allowance, you have deducted the pension, you have deducted personal allowance, and the staff has 1.1 million left, is a range. First 300 at 7%, the next 300 at 11%. We have next 500,000, which makes it 300 plus 300 plus 500, that's 1.1. That will be taxed at 15%. If after removing all of that, and you have 1.6, that 1.6 will be taxed at 19%. So we have 7%, 11%, 15%, 19%. If you're earning so much money and after deducting all of your taxes, you have 3.2 million, it will be taxed at 21%. Anything above 3.2 million, like you, Uche, you're earning big, you're earning 500,000 a month. I'm assuming, because I know you earn more than that. So you're earning 6 million. So after deducting 200,000, 20% of 6 million, if you're paying pension, we deduct all of that. And your money remaining, the net income remaining is 4 million. It means you will be taxed at 24% because your money, the disposable income, the taxable income is more than 3.2 million per annum. So for all of you doing business as a startup, earning money and you're not paying taxes, what you're doing is you're evading tax. And what does that mean? When government comes to your business, for example, and they ask you for your tax receipt and you're not able to pay that, every year you do not pay, you pay that money plus 50,000 naira every year as penalty for your personal income tax. Then your company will pay 500,000 naira every year that you fail to pay your staff taxes or your taxes. For example, I work with Alexander Stephen IQ and my salary is 75,000 naira every month. So if I am not paying that 6,000 naira every month, one, I personally have infringed on personal income tax law. Then Alexander Stephen IQ, which is my employer or my company paying me taxes, has infringed on personal income tax act law, and it is bound to pay 500,000 every year that it does not submit my account or my taxes, my salary for taxes. So let me go back to the assets. Now, when it comes to assets, when you buy assets, there is a tax implication. Government gives you what we call capital allowances. You see, that's why we employ people, we implore people, sorry, that every business you're doing, I have just done 40 minutes, so I'm just going to round up in 5 minutes. Every business you're doing and you acquire assets and you put those assets to use, government gives you what we call capital allowances from 10% to 95%. For example, if you buy a laptop for 500,000 and you buy it this year and you put that laptop for use to use this year, government give you as high as 25% every year for the next 4 years as rebate. So if 25% of 500,000 is 125,000, so what that means is that in a year, you have a tax credit with government up to a tune of 125,000. So if you do business, say your turnover is 100 million and your cost of doing business is 80 million, and then by the time they calculate your tax is 100,000. You will only, your tax is say 150,000. You will only pay 25,000 naira cash because you already have 125,000 naira with government as a result of you acquiring asset. That is why every startup that we deal with, we make sure first and foremost that give us the record of your assets, give us the cost. However, the ownership of your asset must not be in doubt. The ownership of your asset must not be in doubt. So if you personally bought an asset and you are using it for business, you have to prove that although the asset is bought in your name, but the usage is for the business. So you do what we call transfer of ownership to your business because your business is a legal entity that is different from you and you're different from it. I don't know if I'm clear on that, particularly on the issue of asset. I'm going to wait for questions. When it comes to policies, strategies, and procedures, all of them have tax implications. For example, the moment StartupSouth decided to set up at GURK Road, it has decided that in terms of location, in terms of operation, it is going to set up its business in a community. The community is called Eliuzu in Port Harcourt, if you're familiar with that community. What does that mean? There is a tax implication. The community will demand for operational permits. The community will demand for business premises. The community will demand for development levy. Now, most of the taxes collected by different agencies, we have 3 tiers of government, the federal, the state, and the local government. All of them have what we call the Joint Revenue Board, the Joint Tax Board, for which there is a single policy that helps everybody to collect taxes so that there is no double taxation or multiple taxation. So if you live or operate in a community, so what happens when the asset is on hire? Fantastic. When the asset is on hire, your asset is depreciated over the lease agreement. For example, if the asset is on finance lease, what does that mean? All of the expenditure is passed to you. The only thing that is not passed to you is ownership. Now, I don't know if we've got a lot of time to explain that. We have assets that are free held, and we have assets that are leased. So if your asset is operational lease or finance lease, there are different taxes, there are different implications. So if it is operational, it means that when you're using the asset, when anything happens to the asset, you don't repair it. The repairs and maintenance is passed back to the owner. All you have is just the possession and use. You can't claim any tax on that. But if the asset is with you, you're using it, and the maintenance, the usage and the maintenance cost is passed on to you, we call it finance lease. It means that both the burden and the benefits are with you. Then you can claim all of that. I hope that settles that. Now, in my years of doing financial due diligence with a lot of startups, we see people doing so much, but so less in the area of bookkeeping and record. Let me shock you. A lot of businesses, as fantastic as they look, as beautiful as they sound, will have benefited from huge funding, except because they could not keep their records. And because anybody giving you money, the first thing they want to see is first, how much of your own personal money have you committed into this business? How much of your personal money have you committed into this business? 2, how much more do you need to scale this business? And 3, if I give you this money, what do I get? It is called cost of money. That's the implication. It is called cost of money. So you go to the bank, you shout and say, the bank don't give loans, they don't give funds. And they say, bring your books. What do they want to see? They want to see your revenue from your basic operation. From this business you're doing, what is your revenue? What is your income? What is your total revenue? What is your turnover from this business, from your main business operation? How much do you generate? Then secondly, they want to see how many people have put money into your business since you've been doing it, since you've been operating. How many people have put money into your business? How much of money have you attracted, either from families and friends or from other persons? Then thirdly, for how far you've been doing that business, how much have you invested in that business? So here is the problem. From your income statement, the fund providers, the investors, the angel investors, or the people doing bootstrapping and all of that, providing funds, they want to see from your operating activity, how much money have you generated? From your investment activity, how much money have you generated? From your financing activity, how much have you generated? If you're not able to keep your records to show these 3 things, nobody is going to give you money. Yes, your business is fantastic. Your business is good. Your business is scalable, but you need additional funds. But they need to see what is your financial position. What are the changes in your equity? How much money have you borrowed so far? How much money have you paid back? What is your capacity? And all of these things have tax implication, because if you borrow money to do business, it is tax deductible. If that money is plowed back into that business, government gives you back whatever interest you pay. If you go to Bank of Industry and they say you pay single-digit interest, and then allows you to incur that tax, that expenditure without you paying taxes. Now, in closing, what does your accounting and tax record shows? First, the investors want to see all the product and services you have into cash. Your ability to generate cash is very, very important. Only your financial record will be able to show that. So this is the first thing, cash availability. How much of cash are you able to generate? Investors look at it and say, if everybody you are owing comes to your business at once, say you're owing Bank of Industry, you're owing StartupSouth, you're owing Tunde Bello, and everybody comes once in a day to say, can you pay us our money now? The first thing is they look at your liquidity status. What is liquidity? Your ability to settle your obligations when they are due without further expending or extending it. The next thing is they want to see your profitability. What does profitability mean from your records? Your record that shows how much money you have available and how much you have been able to turn that money into profit. I'm not talking of break-even. A lot of people use break-even without understanding what it means. Break-even means you have 100 naira, you spend 100 naira, no profit, no loss. Break-even is not an item that everybody wants to see, because break-even means you're just stable, you're not doing anything, you're not generating additional money. So if I give you money, what is your profitability capacity? Your record shows it. Your tax account shows it that, okay, when you are doing business, you've been able to settle your taxes and there is still money left in your account. People will say, where is the profit? If you're doing business and your record shows your profit, you're going to see it in 3 places. 1, you're going to see it in your bank or cash account. You're going to see it in your assets that you have acquired. And thirdly, you're going to see it in the owners that have withdrawn it. Most times we see people who withdraw money, they pay themselves every time without giving credence or consideration into the people who have invested the money. Then the next one is they want to see your stability. In the face of all of these global issues, how stable is your business? Can your business withstand the test of time? Only your financial record will show it. And how does it show it? It looks at what you owe and what you own. What you owe and what you own. If there is no record that shows how much money you have owned or how much money you are owing, and the difference is called net worth. You have a number of assets, this is the value. You have a number of obligations, this is the value. You remove your obligation from your asset. The difference, if it is not able to pay your debts or pay the people who are putting money, your business is not stable. Leverage. What are you leveraging on? Your record shows the number of customers that you have. Your record shows the number of invoices that you have issued. Your record shows the number of products that you have in your store as inventory. Your record shows the amount or percentage of your market share. That's what we call leverage. So when your financial record doesn't show all of that, then you have a problem. The accounting and tax implication of startup is that you have to keep records and you have to keep track of what you're doing so that your liability is not greater than your asset. Thank you very much. I would like to take some questions now before I move forward to something else. Thank you, Richard.
Okay. Thank you so much. So we're going to spend a few minutes answering questions. I have a couple of questions myself, and
yourself.
Yes, I have a couple of questions. Don't worry. The ones I sent on the group wasn't for you. You've answered them already, so there are others I need to ask you. First one is, with your experience doing financial due diligence for startups that are looking for investors, what are the most important factors you found? What are some of the biggest mistakes you found that startups are making?
Okay, fantastic. Number one is, of course, improper record keeping. And that has to be localized to pre-operational expenditures. Most of them don't have record of what they used to start the business. Investors' funds, how much of money you've committed into promotion, into ideation, into logical setup. Then two, arrogating so much money to themselves in terms of salaries, allowances, expenditures. For example, I saw a startup that spent half of its expenditure for a year on travels, air tickets, lodging, hotel, and accommodation. While I am not oblivious of the fact that you have to spend some of those monies, but the truth is, I mentioned something, and look at it. This is it here. Reasonableness. 2, wholeness. 3, necessity. And 4, exclusivity. If what you're spending money on is not reasonable, for example, I have a phone here. I have 2 phones. Let me put it that way. One is 80,000, the other is 40,000. And they can do much for me. And then because I'm the CEO, I went to buy another phone, and that phone is costing me maybe 150 or 500,000, and I call it asset. The next question the tax man is going to ask you is it necessary? And if it does not meet that criteria, it is written off back, and you pay 32% of it as tax. Now, what I'm saying is that one of the major mistakes startup makes that I have seen is not having control over their expenditures, or not setting boundaries for their expenditures, lack of record, and there is so much vague projections. So I'm going to stop there. Vague projections. When you're projecting, it's good to have all of those good figures, but reality, you're projecting on dollars, you're projecting on pounds, and you're putting those figures there just to make your record look good. When the financial consultant look at it, is asking you a question, how are you intending to make this? And you're not able to explain, it becomes a problem. We'll check.
Just to carry on from your last point, right? So is the problem the bogus projection? Okay, let me not use the word bogus. Is the problem the big projections or the lack of the how to meet the projections? Because I would think that I will not have a problem with someone who says I can go to the moon, right?
Yeah, yeah.
But I will have a problem if he's not able to tell me or show me how, right?
Exactly.
So just hold that. Let me add this question to you.
Right.
It seems like you were reading, you know, your spirit is, so I don't want to talk about that part.
My spirit is what?
No, it seems like you are reading some people's mind.
Yeah.
I have a question here from Jeffrey that says, can businesses apply for tax rebates and how? So I think you started answering some of the how, you know, so maybe you should elaborate a bit more on the tax rebate.
Can I hear the question again?
Can businesses apply for tax rebate? Did you get it?
Yes, scribed form. Yes, I get it. I get your question.
Okay.
A company can apply for tax rebates. We call it tax allowances in Nigeria, but you have to present your financial records. You don't come to equity with dirty hands. So you want government to give you a rebate or a tax allowance, you need to present the reason. We call it objectivity. You have to be objective. Okay, why should I give you tax allowance? The next thing is, okay, I bought 2 laptops during the year costing me 1 million naira, and I put them to use. And government says, can you prove the ownership? Can you prove the cost? Can you prove the benefit? Can you prove the presentation? Can you prove the valuation? And lastly, can you prove the existence? The first question is, can you prove the cost? Can you prove the benefit? Can you prove the valuation? Can you prove the presentation? Can you prove the existence? And can you prove the ownership? If you're able to do all of this, government gives you allowance. And then the next thing is, government looks at your record. If you have not hidden any revenue to deny it the taxes that is due, you cannot deny me my taxes and you're asking for refund or allowance. Do you understand what I'm saying? So you've made 100 million, you did not pay VAT. Now you have incurred 50 million, you want me to give you allowance. Government says, no, you have to show me that this 100 million has actually suffered the accurate and correct taxes that is supposed to have suffered. And you can only do that by your financial record. Like we've asked so many questions that we push back to you that, okay, let this company tell us that, okay, you have been able to acquire this asset and you prove to us that you are the owner. And the only way you can prove that is to generate and bring your receipt of ownership. So most times people go buy stuff and they don't have proof that they are the owners or the business is the owner. But as a matter of law, in the 5th schedule of Company Income Tax Act and the Finance Act of 2020, government lists every avenue through which you can have access. For example, if I go to Oguta, for example, I know that there is a lot of, or let's say, expanse land in Oguta, and nobody is able to have access to it, but we want to build, let's say, a university, or we want to build a business there. And we cleared the whole of that road, and it cost us 10 million naira to clear that road. The whole of that 10 million will be given to you as an allowance by government. If you're able to prove that you actually spent that money to make people have access to a business environment, it's called investment allowance. It's part of the law of company operation in Nigeria. The problem is that, 1, we lack trust in government. 2, we don't want to do the right thing.
All right. Thank you very much. Yes. Okay. You can actually ask him now. See, he can hear you. Go ahead. Just introduce yourself and ask. So today we have some people in person here. Deep praise asking you.
Fantastic. I can't hear anything. I don't know if he's talking already.
You can hear. Go ahead. I'll put that. The question is, what percentage for the allowance, and what is the duration? How fast can anybody get it?
Okay, it's not strict jacket thing. We have our own back end formulas and all that. For example, let me give you, for example, if you purchase an executive table, for example, costing you 100,000, government gives you allowance from first, we call it initial allowance of 25%. And then that 25% means that the first year you get 25,000 naira as allowance of that 100,000. So you have 75,000 of that value of that asset left. Then the remaining 75,000 is spread across 5 years, which we call annual allowance. So for every year you put that asset to use, you get 75,000 divided by 5 as annual allowance, apart from the initial allowance of that 25,000 naira. So, but how do you get it? You get it in terms of tax credit, not cash. So if at the end of 2020, you made 100 million as turnover, and we are able to certify that, your accountant or your account consultant is able to certify that, and then your cost is 80 million. So you make a profit of 20 million. And currently, Nigerian tax rate is 32%. 30% for income tax, 2% for education tax. So the 20 million at 30% is 6 million. And you are supposed to come forward and pay that 6 million to government. But you have acquired assets to the tune of, say, 20 million, and you have tax credit of 10 million. You will not pay a dime to government because government is already owing you 10 million. So from your 10 million, you're going to offset your 6 million from that 10 million, and you carry forward the remaining 4 million for the next 4 years if you do not exhaust it in the following year. I hope that is very clear. Now, how it operates is that if, for example, you deal with British Council, you've given them an invoice, the invoice is 20 million, and they deduct WHT for that service you're rendering for them, and WHT is, say, 4 million. Now, WHT is withholding tax. It's different from asset allowance, which we call capital allowance. Now, if you have WHT of 4 million in your credit, and you are sure that the people who enjoy your service or who buy your product and deducted as remitted to the FIRS or the state internal revenue, and of course you can, I think we have to do another session where I show us how we can log in into our platform and portal and get access to all of our records to see whether the people we are dealing with have actually remitted to the Federal Inland Revenue Service or the State Internal Revenue Service. So with that 4 million naira withholding tax that has been withheld from your 20 million, any tax you're paying that is not up to that 4 million will be deducted from that 4 million, and the remainder carry forward. But if your tax at the end of the year is more than that 4 million, you only cough out the difference between that 4 million that is standing in your credit and the tax liability that you're supposed to use to settle the government. So basically, the only way you can do it is for your financial record to be intact. And what does that mean? From the beginning, your monthly records, your monthly calculations, your invoice management, your vendor management, all of those little things that seem not to matter, when you're able to capitalize on that and put them to record, then you're able to present your financials.
Okay, thank you very much. So for me, I was going to say, you just mentioned it briefly. I was going to say, so this is why it's important for startups to insist on getting invoices for people who do stuff for them, and
yes,
even for stuff that they buy,
yes,
because it's one of the ways to prove ownership, ownership, and all of that stuff. So that's one. Second thing I want to ask you is, how is capital allowance different from capital gain tax, right?
Oh, fantastic.
And then the third question I want to ask you would be, if you're to advise startups on getting accountants, how early should a startup get an accountant? What should they be looking out for in an accountant? And I mean, general kind of advice. I mean, we're dealing with startups here, so what would it be?
Fantastic. Okay, the first thing is capital gains tax. I mentioned, I didn't talk about it, but even though it's in the slide. What is capital gains tax? First is the most underutilized tax in Nigeria, and it is a tax that is paid on profits gotten from disposal of assets. For example, you have an asset, you have a laptop that you bought in 2015, and by 2020, you disposed that asset. By 2020, in the face of the law, that asset is fully depreciated because it has a lifespan of 4 years. That's what the law says. There is what we call the fifth schedule in capital allowance. In that fifth schedule, there are categories of assets. We have plant and machinery, we have office equipment, furniture and fittings, motor vehicle, plantation, oil palm, jetties, wharves, aircraft, and all of those things. These are categories of assets. We have buildings, we have commercial buildings, we have property and plant, and all that. All of them have their categories of capital allowances. For example, motor vehicle, the annual allowance is 25%. The initial allowance is 50%. Let me use that as an example. So you bought the motor vehicle in 2015. So the annual allowance is 25%. It means that it has to use 4 years. So you have to depreciate that motor vehicle over the lifespan of the asset, which is 4 years. So if by 2019, which is 2016, 2017, 2018, 2019, it means that by that 2020, January of 2020, that asset has been fully used and fully depreciated, there is no value. And you sold that asset for 10,000 naira. To you, it may be like a loss, but you have fully enjoyed the benefit that asset has. In the face of government, you have made a profit of 10,000 naira. And what that means is that 10% of that 10,000 naira has to be sent to government as capital gains tax. Most Nigerians don't do it, but government looks at it and say, you claim you have this asset in 2015. Where is the asset by 2020? Is it scrapped? Is it lost? Is it sold? If it is scrapped, they are going to remove it from your record because you can't keep carrying what is not in existence. That's why I say you have to prove the existence. If it is sold, you have to prove to government that you made a loss. If not, whatever amount you sold it, you have to assume it is a profit because the asset is now zero value. When you sold your Nissan Uche, did you pay capital gains tax?
Let's continue.
So what I'm saying is that government looks at all of that because you have gained from government for using that asset. Now that asset is no more in existence, you sold it and pocketed the money. Government is saying that money is profit. Bring the tax on it and it is 10%. Now, you asked the second question about what kind of accountant and all of that. Now, I always advise.
Before you go into that, let me jump in.
Okay.
So that we can harmonize this and hopefully it becomes our last question, right?
Right.
So we talked about depreciation and we talked about capital asset allowance, right?
Yep.
There are two different concepts, and
Okay.
I like to understand, and they seem related, and I like to understand the connection. Because depreciation typically allows me to deduct the value of the asset over a period of time. Yes. And you're telling me right now that the government also pays me back that value over a period of time, right? Mm-hmm. So, yes. And again, the government is supposed to allow the depreciation in my book. So how does that work? I'd like to get clarity on that. So when you answer this and connect it, you can go to the last question.
Okay, fantastic. You of course, because of your knowledge of one suit, you already know all of these things. But let me say that depreciation is not allowed in government taxation. The reason is this. Let me make a funny joke as I used to teach. Let's say I have two young guys in the community. Two of them have a wife and one has a wife that weighs 70 kg, the other has a wife that weighs 100 kg. And the two of them came to their husband asking for a motor vehicle as a birthday gift. And the two of them are born the same, the same day, the same month, the same year. And the two husbands decided that, okay, let's buy cars for our wives as birthday gifts. And they went for an SUV, let's say Hyundai Accent or all of that. And the two of them got the cars, everybody's happy. Now, the same cars, the same car, the same amount of money, the same year of purchase, the same brand, and everything's same. But in terms of usage, which car do you think will depreciate fast or faster between the two? I think if we're looking at the weight of the women, the one with 100 kg weight will depreciate faster than the one with 70 kg weight because of usage and weight. Now, what is depreciation? Depreciation basically is wear and tear of an asset. So if I decide that my laptop can serve me 20 years or 10 years, so be it. Because of my usage, maybe I am not always on my laptop, I'm just using Excel. But you that you're into graphic design, digital marketing, and all of that, you're constantly and every day, every time using your asset. You look at that laptop, say laptop won't last more than 10. The same laptop, the same value, the same date of purchase, but different depreciation rate. So how will government harmonize it? You're claiming your asset will spend 10%, 10 years. The other person is claiming his asset will spend 5 years. Government says, see, whatever it is, I am not going to allow it, but I'm going to give you an allowance, which is standardized. That's the difference between capital allowance and depreciation. So now let me tell you a joker. If you use your asset, you use your laptop for 10 years, and another person uses their laptop for 5 years, the person, if the two of them are in the same industry, one person's profit will be lower than the other person because depreciation is higher in one and depreciation is lower in the other. So government looks at it and says, the same industry, the same revenue, the same market, but different profit. No. So we add back that depreciation amount to your profit or to your loss. Then we now get the real profit. So government now charges tax on that. But before it charges tax on that adjusted profit, it gives you what we call an allowance that is standardized for everybody. So if you make 10,000 naira profit and the other person makes 8,000 naira profit, but your 10,000 and 8,000 is as a result of depreciation rate differences, they add it back, you arrive at the same profit, and they apply the same rate, and then they give you the same tax rate. So it is fair. We call it fairness, because what is fair to you may not be fair to me. For example, if in Avila and Hills, you normally give people 10,000 naira to go and buy fuel, and they come back, the fuel they buy is the fuel of 900 naira, and you don't usually ask them for the 100 naira. So you put it in your record as fuel for 10,000 naira. Do you understand? But in my own place, fuel is 9,900, transport is 100 naira. So in my record, I am seeing transport 100 naira, and I am seeing fuel 9,900. But in your own record, you're seeing fuel 10,000 naira, because you don't assume the 100 naira is substantial or material enough to be counted different from that purchase of fuel. So these are the logic behind accounting record. So that brings me to the kind of accountant. Accountant has to be conversant, he has to be smart, he has to be disciplined, he has to be sincere, he has to be accurate, he has to be meticulous. But most startups can't afford that kind of accountant. And that is why Alexander Steven IQ bridges the gap. For example, you can't afford to have an accountant who doesn't generate money for you. He's sitting down to wait for the money you generate so that he can account for it. Does that make sense? So he sits down in the office, whether business day, business no day, you must collect salary. Do you understand? So you go about doing your marketing, and then people patronizes you, and then they pay. You say, how much did they pay? He issues receipt. After he issues receipt, what does he do? He sits down. So accountant is not just a bookkeeper. Accountant is a management support system. Accountant is someone who gives you information for decision making. Okay, last month we hit 10,000 naira for telephone. Today is 15, and we've already spent 9,000 naira on telephone. What does that tell you? You need cost control. Okay, last month we hit 10 million naira turnover. This month is 15 already, and we are just 2 million. What does that tell you? You need to speed up your income generating activity and marketing skills. So that's what an accountant provides. So if you are a startup and you can't afford an accountant, what you should look at is, I'm not advertising now, look out for me. That's why I said, I'm clearing your mess, you know? So look out for me. What I do is, if you are willing to pay an accountant 60,000, I tell you, pay me 30,000. I give you the 30,000 back. What do? I give you a template with which you put in something, and at the end of the month, I give you a report, and we sit down face to face, physically or virtually. We discuss your account, and I tell you, these are the flag areas, these are the gray areas. You're going beyond threshold. You're not meeting your budget. I'm preparing your cash budget for you. I'm preparing your payroll for you. You're only focusing on your core business. I'm paying your taxes for you. By the way, you know that if you don't file your VAT next week on or before 21st, you're going to pay 25,000 naira to government. Whether you do business or you don't do business, 25,000 naira. By the way, do you know that if by the end of this June 30th, and by 1st of July, you do not submit your account to government, you're going to pay 50,000 naira for not doing that. And for every month you delay and you do not come forward, 50,000 naira is accredited to your account. So you're incurring tax liability for your company because you do not have an accountant, because you do not have the knowledge of all of these things. Unfortunately, we do not have time to talk about the tax liability aspect of ignorance. For example, if I render service to Avila and EUs, I came to advise you and I give you a bill of 100,000 and you're paying me, you did not deduct WHT. It's an ignorant act. And what does that mean? When government comes to you, you will pay that 10% actually, because professional service is 10%. And you will pay interest at going rate. And the tax controller has the discretion to apply a rate that is higher than the minimum interest rate on the economy. So most of the things we're doing, we say government is bad, but because we have refused to trust government and we have refused to do the right thing at the right time. And also, we feel that if we pay tax, what do they use the tax for? That's the morality of what I was discussing earlier. But the question is, if your forefathers didn't pay tax, how will you see this rule apply?
Okay, Tunde, thank you very much. I know that I said we were that was the last question, but I just thought I should add this. But is it possible to just use 60 seconds and give me the answer for this? Do you pay tax on grants? Under what scenarios would you be required to pay tax on grants?
Usually, you don't pay tax on grants because that's the name, that's what it is. But whatever you use the grant for, and the result of that grant, you have to pay tax on it. Does that answer the question? So
I'm not so clear.
Your money, you have a grant comes in, they don't call it revenue, they don't call it income, it's a grant. But you put that grant to use, you put it into business operation, and you make profit. That profit is subject to tax.
Okay, no, that's clear. I understand that. Okay. All right, thank you. Thank you so much, Tunde. This has been great, and I want to believe that everybody who has joined has been able to pick something. And thank you for those of you who made time to come here in person to join. Tunde, I trust that we will have time to have another session to discuss other topics in the coming days and weeks. Okay, so everyone, thank you so much for joining this session. Don't forget, you can join if you're interested in getting the NetSport scholarship. You can use the link bit.ly/ss-scholarship. So that's from NetSport University. So you can get a scholarship. You get free application, courtesy StartupSouth, and then you also get the opportunity to get at least a month's fee paid for you.
Okay, can I say something?
Please go ahead.
With anybody within the network, maybe this for the want of saying it's not that bad. We're going to give support. So far, you come through the Startup South network. If you're having difficulty in your finances, we will give. It's not going to be free though, because these are hard times. But we will give a considerably.
No, Tunde, you know that. Tunde, don't worry, you know you pay commission as well. So that's okay. So what Tunde is trying to say is that Tunde is about to give us discount, right? So if you have
discount,
so that's fine. We'll first get the taste of the discount. So if you have, that means some of those other invoices you sent will be cancelled. So if you have, don't worry, they owe me some commission already. So if you have difficulties with your books, with your accounting, Tunde Alexander Stevens is looking to help support startups in the community. That's in a nutshell what Tunde is trying to say. The details we will make available in the coming days, but I believe it's going to be, like he says a generous discount. He has already told us what he charges other people, so we should know what the discount will look like when it comes, right? So that's what it's going to be. Tunde, by holding you to your word. Thank you very much.
Oh, fantastic. I'm a man of integrity. That's how I'm trained.
All right, cheers, Ross. We'll talk later. Thanks, everyone.
Thanks, guys.